Hi, welcome to this week's Q&A. We're going to cover off a couple of interesting points today. A lot of people have been asking me, and not just now, but even during the course of last year, during when COVID was amongst us very severely, what's going to happen to property prices when government stimulus cuts out? So, JobKeeper, JobSeeker, all the specialist, endeavours that the government has put forward to help the economy, to help people, help employees and employers get through this particularly difficult time. And it's on public record because obviously we did public Zooms. My thoughts about this were that the government stimulus was going to be carried on for long enough to make sure that everyone got the full benefit of this, and we weren't going to see, as the September, October cliff, and then, the December cliff. And now people are saying, what's going to happen when JobKeeper stops at the end of March, and JobSeeker gets reduced? And my answer is the same as it was then. I don't think that's going to have any significant impact on Australian residential property prices. And there are a number of reasons for that, but the most important one is that a lot of the people that are actually receiving these benefits are generally younger, and perhaps in industries where the actual level of pay that they're receiving is lower than perhaps some of the median employment numbers that are out there in terms of wages. So these people are more likely to be in the rental market rather than property owners. So they're not going to have severe, if you like, financial difficulties to make them sell a property. There may be some areas where if we have some stress in the rental market, that could sort of seep back to property owners. But I think in the main, if people have good quality residential property assets in sought after areas, which is something that we always recommend that our clients certainly do, then you're not really going to suffer a lot in terms of a reduction or a cessation of these government stimulus measures, because there will be certain ones that I think will be carried forward. As we've seen to date, the aviation industry may need some extra help, certain areas of F&B, retail, the arts, etc., etc. And I think, the government's well aware of this and will probably target those industries to give them some more support going forward. So, the bottom line is, for all those people that have been waiting for a September cliff, October cliff, December cliff, or any other cliff for that matter, I think you've probably been waiting for the wrong reasons and too long, because I think that property prices are going to continue to move upward. We just had the latest data out from CoreLogic, and the consolidated property markets around Australia moved up by 2.1% February, which is a very large move on a monthly basis. So I think people need to be cognizant of the facts rather than perhaps what they would wish the markets to do for them, because they've been holding off to purchase a property in the hope that markets will crash for whatever reason that they propose. I don't think that's going to happen at all. In fact, I think it'll be the opposite. Australian residential property prices are more inclined to react to increases in interest rates or decreases in interest rates. And with the current very accommodative policy settings that the RBA has, I think we're likely to see further price movement increasing over virtually all property markets in Australia, but certainly the quality ones. Now that brings me to our second question, and again, it's something that's been very much in the news in the last couple of weeks, where people have been calling us from all around the world, in Australian expats, saying, oh look, do you think I should fix my loans? Do you think I should fix my mortgage? And the answer is, I suppose, the same as always. It's not about picking the lowest interest rate. It's more about trying to work out what to do in relation to what's best for you. So take this, I suppose, as perhaps a little bit of a jolt, where news articles are saying that, we might see inflation coming in, 10-year bond yields, particularly in the US, but also in Australia and New Zealand, have spiked over the last week. So I think it's something that no one has a crystal ball, but I think this is something that we might see a spike up in 10-year bond yields. But I don't think it's going to potentially be here for the long term. And I think that's the important issue. You know, we've got to make sure that this accommodative monetary policy that central banks around the world have embarked on actually persists for long enough so that, you know, full employment can be maintained or attained and then maintained, and that inflation can go to the target bands, which are set at between 2 and 3% by the RBA, and other central banks have their own settings. But, you know, I think that's still quite a long way off. And I think that some of the hype may go out of the market as central banks calm those bond markets and we see what transpires. So, you know, it's not like a very novel experiment. I was talking to a client of ours in the UAE the other day, and I said, if you look at Japan, I mean, we've had, you know, negative and ultra low rates over there for decades, and inflation hasn't come along or run away anywhere because it's maintained a very, very low inflation world. So I think that's something that we need to bear in mind, that these things are going to be perhaps upon us for a longer time. Thanks very much once again. We'll see you next week at our Q&A.